So let's have a look at superannuation funds now. With a superannuation fund, it's the largest type of managed fund in Australia, and it accounts for almost 20% of all assets held by financial institutions. And of superannuation funds, the self-managed super funds have the largest amount of assets within the superannuation sector and hold more than $500 billion in assets. So what is superannuation? Well, in Australia, since 1992, we've had a compulsory superannuation system governed by the superannuation guarantee charge, and basically it was designed to increase the level of retirement savings for the working population. Now, over time, the level of the SGC has changed. Before July of 2021, it was 9.5%, but since July 2021, it has increased to 10% of an employee's wages or salary that goes into this special superannuation account that is saved for retirement. Now, because the employee, generally speaking, there are exemptions to this, can't withdraw their superannuation money till they retire, this means there has been an explosion in the size of funds under management holistically across the market, as well as an increase in the size of funds in a superannuation fund for an individual as they earn money over time and move towards retirement. Now, just a couple of other things. You're paid superannuation by an employer provided you earn over $450 a month. And the SGC is going to continue to increase, eventually increasing to 12% in 2025. Now, that's not guaranteed by any means because the government in the past has altered the timetable for the SGC with respect to the increments, but that is the current plan. Since September 2013, superannuation assets have exceeded 1,700 billion. That's a lot of money. And the different types of superannuation funds involve corporate funds, industry funds, retail funds, small APRA funds, and self-managed funds. And as we said before, self-managed funds have most of the assets in the superannuation system. We have rollover superannuation funds. So for example, if you change jobs, you can roll over your superannuation into a new super fund by receiving what's called an eligible termination payment. So basically what happens there is, let's say you change jobs and you want to transfer your superannuation money from your existing super account into a new super account, then this ETP, which is the money from your old superannuation account, will go into your new super fund. And then as you start earning money from your new job, then your employer will make superannuation contributions into your new super fund. So all of that money can stay pulled together. Now we're going to look at superannuation in a little bit more detail and describe the difference between defined benefit funds and accumulation funds. On one of the previous slides where we talked about the SGC of 10% and how that was going to go up to 12% over time is referring to the accumulation-based funds, where the amount of money that you'll have at retirement consists of those contributions which are currently at 10%, plus any earnings that you get from investing that money in the superannuation fund. That money might be invested in equity or fixed interest securities, for example, less any taxes and expenses as a part of that superannuation fund. Now, defined benefit funds are very different. They were much more common in the past. However, they're not so common anymore, and most commonly now we have these accumulation-based funds. Now, the way that a defined benefit fund works is the amount of money that you get paid on retirement is based on a predefined formula which has things like how much income you earn as well as your years of service, for example. So in that case, the risk lies with the employer, because with a defined benefit fund, how much you get on retirement is independent to your investment returns. So if there's not enough money in that fund to pay you so many times your final average salary, then the employer is required to make up that shortfall. So in essence, accumulation funds are transferring the risk of not having enough money at retirement to the individual, whereas with defined benefit funds, that risk is lying with the employer, who through that defined benefit fund has agreed to give you so much on retirement based on that formula. With respect to regulation, there is the Superannuation Industry Act and the Income Tax Assessment Act, which cover the operation of superannuation. And one of the things that is good with super is it's concessionally taxed, so it's only taxed at 15% with respect to fund contributions and earnings. With personal income tax, it can be a lot higher than 15%. So that's why we say superannuation funds are concessionally taxed. And generally speaking, the rule is that you can withdraw your funds as a pension or a lump sum tax-free when you hit 60. That may change in the future though.